Hello everyone. Today we're going to talk about the new chapter, Chapter 12, Lessons from Capital Market History. We're going to talk about the returns and the risk, the historical records, how to calculate the average returns, and how to calculate the risk or the volatility of returns. We can examine the returns in the financial markets. That will help us determine the returns on non-financial assets. First of all, what lessons can we learn from the capital market history? The first lesson is there is a reward for bearing risk. For example, when you invest in stocks, you are going to have a reward for bearing the risk of the stock price drop. If you invest in S&P 500, on average, the annual return will be ranging from 8 to 12% depending on what years you're looking at. So there is a reward or return for taking risk. The greater the potential reward, the greater the risk, means there is no free lunch. If you want to have a higher return, you take higher risk. This is called a risk-return trade-off. When we talk about returns, we talk about the dollar returns and percentage returns. What is dollar return? So the total dollar return is going to be the income from your investment plus the capital gain or loss due to the change in price. So here the income. When you invest in stocks, the income is your dividend payments at the end of each quarter. When you invest in bonds, the income means the coupon payments you received annually or semi-annually. For example, when you bought a bond for $950 a year ago, you have received 2 coupons each. It's a semi-annual coupon bond. You can sell the bond for $975 today. What is your total dollar return? So the income or the coupon payments are the 2 coupon payments of $30 each, totally $60. Capital gain, or the price change, which is the ending price, $975 minus the beginning price, $950. Capital gain, $25. So the total dollar return will be the sum of the two, $85. Sometimes it's more intuitively to talk about percentage returns rather than dollar returns. So what is the total percentage return? We can decompose the percentage return into 2 parts, dividend yield and capital gain yields. Okay, so the dividend yield will be your income divided by your beginning price. By beginning price, it really means your investment or your initial investment or the price you paid for the asset. Income here again can be dividends or coupon payments. Capital gain yield is going to be the percentage change in the asset price, which is the ending price minus beginning price divided by the beginning price. So total percentage return will be the sum of the dividend yield plus capital gain yields. If you look at this picture, the total dollar return equals the income from investments, the dividends for example, plus the total capital gain and loss due to the change in the price. So here, initially you make an investment. In the end, you're going to get the dividends and the ending market value. The percentage change in the return is going to be the sum of the cash received and the change in value of the assets divided by your initial investment. Here we have an example. Now suppose you bought 100 shares of XYZ company a year ago. Today, $45 means a year ago at the same time, $45. Over the last year, you received $27 in dividends because each share you get 27 cents and you totally purchased 100 shares. At the end of the year, you sell the stocks for $48. What is your return? So first of all, you totally invest $45 times 100 shares. $4,500 is your beginning price. At the end of the year, the stock is worth $4,800. and you also get the cash dividends of $27. So your total dollar gain was $327, which is $27 dividends plus the change in the price, which is $300. What is your percentage return? The percentage return will be your total profits divided by your initial investment, the beginning price, $4,500, which is 7.3%. Okay. So let's put the numbers into this graph again. Initially, you invest $4,500, and over the investment period, you got $27 dividends plus $300 capital gain. So the percentage return will be the total $327 profits gain divided by your initial investment, $4,500. So the total percentage return, 7.3%. Okay. So the dollar return equals the dividends plus the change in the market value, and the percentage return will be the sum of the dividend yield plus capital gain yields. Another example in the real life, Microsoft paid a one-time special dividend, $3.08 on November 15, 2004. Now, suppose you bought Microsoft stock for $28.08 on November 1st, 2004, and sold it immediately after the dividends were paid for $27.39. What is your realized return from holding the stock? Okay, so basically we need to plug in all the numbers in our formula. You received the special dividend of $3.08. After the special dividend payment, the stock price dropped to $27 and you bought it for $28. That is the total gain of holding the stock divided by your initial investment. You have a 8.51% return. So that is your total percentage return. Now we're going to break down the total percentage return into the dividend yield and the capital gain yield. So dividend yield will be $3.08 dividend you received divided by the initial investment or the beginning price, almost 11%. While the capital gain yield is going to be the change in the price of the stock divided by your initial investment, because the stock price dropped after the special dividend payments, and you have a negative 2.5% return. Combine the two returns together, you got a 8.51% total return. Alright, the next idea is holding period return. So sometimes you will hold the stock for multi-periods, for example, 10 years. How do you calculate the holding period return of the stock over the 10 years? Here is the formula. Holding period return is going to be, for each period you have a return. So return 1, return 2 until return n. So you multiply each year's return minus 1. That is your holding period return. For example, now suppose you have the following investments over a 4-year period. First year, you have a 10% return. Second year, you lost 5%. Third year, 20% return. Fourth year, 15% return. What is your holding period return? All you need to do is multiply each year's return. So first year, 1 plus 10%. Second year, 1 minus 5%. Third year, 1 plus 20%. Fourth year, 1 plus 15% minus 1. Your total holding period return over the 4 years is 44.21%. Okay, so now we're going to look at some historical returns. We have a very famous study who showed, starting from 1926 until 2006, the returns of the large companies, small companies, long-term corporate bonds, long-term U.S. government bonds, and the U.S. Treasury bills. So let's take a look at what happened to the returns of different financial assets. All right. Now suppose you start $1 investment into those different assets in 1925. Okay, so the purple one is the inflation, means $1 in 1925 is equivalent to 13.49 cents in 2016. Okay. Now, suppose you invest in the treasury bills. You invest $1 in the treasury bills in 1925. In 2016, it's going to worth about $20. Well, it's not really bad. It beats inflation at least. If you invest in the long-term government bond, $1 will turn to $133 in this long time period. But if you invest in the S&P 500, the large companies, $1 will turn into $6,000. While if you invest in small stocks, riskier stocks, your $1 investment will turn into $33,000. So here are the summaries. Over this long-term period, the large stocks, you can think about S&P 500, has average return of 12%. Small stocks, 16%. Long-term corporate bonds, 6.3%. Long-term government bond, 6%. T-bills, 3.4%. Inflation, 3%. So here I want to introduce the idea of risk premium, that is the actual return earned for taking on risk. So what is risk premium? When you think about the risk premium, it is the premium of returns over a risk-free asset. What is risk-free asset? The treasury bills. It matures within 1 year and is considered as default risk-free, means the US government will never default on the treasury bills. You can sleep sound over the night because you know your money and your return will be paid by the central government. Alright, so the risk premium is the return over and above the risk-free rates or the T-bill rates. Okay, go back to the previous table. Now let's calculate the risk premium of each investment asset. The US Treasury bills pays 3.4% over the long period, which means this is a risk-free return. Without varying anything, 3.4% is the return you are guaranteed. Okay, although the large stock offers you 12% return, but there is risk. By holding stocks, you are taking additional risk relatively to the treasury bills because treasury bills doesn't have any risk at all. So the risk premium is going to be the average return of the large stock minus the risk-free rates, which is the T-bill rates, 3.4%. The risk premium is 8.6%. So this is the actual return for you to hold the large stocks versus the US Treasury bills. Small stocks, 16.6% minus 3.4%, 13% risk premium. So that is additional risk rewarded to you to hold small stocks over Treasury bills. Long-term corporate bonds, long-term government bonds have roughly 3% risk premium. Now, in this famous picture, we're going to plot the risk against return. On the vertical line, we are always going to report the returns. On the horizontal line, we're always going to report the risk. In this course, the risk is either measured by the standard deviation of the return or by the beta, which will be introduced in the later chapter. So here, we're going to use the stock return standard deviation as a measure of the risk. As you can see, the T-bills offers you the lowest return, but at the same time, it also gave you the lowest risk. Then Treasury bonds, because the maturity is longer, and the government will give you a higher return, but you have to bear a higher risk. For stocks, it gives you significantly higher return, but at the same time, significantly higher risk. Small stock is the same story. Much higher return, but also much higher risk. So there is the risk-return trade-off. In order to get higher return, you have to bear higher risk. Okay, so to summarize, there is no universally agreed upon definition of risk. Standard deviation is one good measure of risk. Later on, we're going to introduce beta to measure risk as well. Okay, so let's take a look at the frequency table or the distribution of the returns. Again, the large companies, the average return 12%, standard deviation 19%. Small stocks offers you higher return comparing to the large stocks, but at the same time, the standard deviation or the risk is also significantly higher than large stocks. So if you look at the distribution, higher standard deviation really means the distribution is wider, so there is more chance you will have a significant loss and significant high returns. While on the other side, we look at the U.S. Treasury bills and the government Treasury bonds. The distribution is very skinny comparing to the stocks. The stock returns are very fat, very wide. While the bonds, the T-bills, the returns distribution is very tall and very skinny. So the standard deviation is very low, 3%, 6% comparing to 20 and 30%. Just want to review what is a normal distribution, because a lot of the time when we study the stock returns, we will make assumptions of the stock returns follow normal distribution. So normal distribution looks like this. When we say within one standard deviation, it really means about 60.8% of the chance the stock return will fall in one standard deviation, this area, similarly to the 2 and 3 standard deviation. For example, 2 standard deviation, 95.44% of the stock return will be falling within 2 standard deviation. More on average return. We have 2 ways to calculate the average return: arithmetic average or geometric average. Arithmetic average return is the return earned on an average period over multiple years, while geometric average return, we are going to consider the compounding power of the return. Most of the time, geometric average return will be less than the arithmetic return, unless all the returns are equal. So which one is better? Arithmetic average return is very simple to calculate, but it's overly optimistic or overvalue the returns. The geometric average return is overly pessimistic for the short-term horizon. So let's take a look at the following example. This is the same portfolios we had before. To calculate arithmetic average return, we simply need to calculate the sum of all 4 years' return divided by the number of years, 4 years in the holding period. So the arithmetic average return is 10%. So basically, you can say over the past 4 years, my average return is 10%. Geometric average return is a lot more complex. All you need to do is first, you calculate the holding period return. And then you use the following formula to calculate the average annual return, which is less than 10%, 9.58%. So our investor made an average of 9.58% per year, realizing a holding period return of 44.21%. So basically, geometric average return consider the compounding power of the return. This is more accurate than the arithmetic return. That's the end of this chapter. If you have any questions, you can always email me.